Greetings, everyone. My name is Vern Broders, and I'm on the committee for the Alumni Finance Roundtable. And can everyone hear me right now?
Yes.
Okay, good. The Alumni Finance Roundtable gathers as often as we can here at the Gleacher Center to discuss issues, the current issues in finance. And we gather sometimes with learned professors and sometimes with seasoned professionals. And today that would be the case. We've got a terrific panel that is going to tell us about how asset managers can deal with the customers and clients' requests and demands for ESG and sustainability. So thank you all for being here tonight. I'm going to ask our panelists to come up one at a time. Guy Laganashak is he is the partner and portfolio manager of LSV Asset Management, and LSV is handles on the order of 90 billion in assets for their clients, and he is one of the people who regularly deals with client questions about what should be in their portfolios. So he should have some interesting perspectives about that. Our second panelist is Liz Michaels, and Liz is the co-head of Aperio Group. And Liz, Aperio Group is a unit of BlackRock, which of course has been very much in the news over the last number of years regarding ESG and sustainability. And I look forward to learning more about how Aperio Group fits into the BlackRock domain. And she'll tell us how her firm deals with some of those questions. And finally, our third panelist is Ibrahim Rashid. And Ibrahim is bringing us his research in ESG as an analyst at Marquette Associates. And he's doing some intensive research in this area of ESG. Guy is a graduate of Chicago Booth, as is Liz Michaels. And Ibrahim is a graduate of the Harris School of the University of Chicago.
That counts too.
So we are generously represented here. Finally, our moderator is Chris Wheat, and he is the director of the Stigler Center, one of the many research centers in Chicago Booth. And he will moderate the series of questions with our panel tonight. I want to say thank you to the Stigler Center for having Chris with us, and I would hope you say a couple of words about what the Stigler Center is up to. I also want to say thank you to the Rustani Center, one of the other research centers at Chicago Booth, for helping us to gather this group. It happens that Liz is an executive in residence at the Rustani Center for social service research. Did I get that right?
Close enough. Social impact.
Yes. Okay. So and so there's these wonderful research centers, and it's part of what makes Chicago Booth currently ranked #1 business schools in the United States, so by U.S. News and World Report. So that's a wonderful achievement. And so, Chris, if you want to take it away, while he gets to the podium, I want to mention on May 24, we're going to have our next session, which is an exciting adventure talking about markets and mania by Professor Oliver, who's a noted scholar in the area of market research and what happens when things don't go right. So I'll leave it up to Chris. Thank you for being here.
Thank you, Vern. So thank you all very much for being here. This is kind of awkward, to be honest. It feels like I'm lecturing you, which it's been a while. I very much appreciate the invitation to be here this evening. It's funny, this conversation around ESG. I actually moderated a panel that Liz was on probably about 13 or 14 months ago with Rustani Center. I titled Unpacking ESG. We're actually doing a new version of that panel with Financial Times this summer. I will give shameless plugs regarding that later on. But the conversation today on ESG feels so much different than the conversation that was being had 14 months ago. And in fact, the conversation may be different than it was 14 weeks ago, given both the nature of the market and how the political and regulatory environment are moving at the same time. The Stigler Center for the Study of the Economy of the State, the center I run alongside our faculty director Luigi Zingales, we spent a lot of time thinking about issues around the purpose of the corporation, what markets look like, and also delving into issues of shareholder democracy, which I'm sure are issues that have come up for many of you. They're issues that you all deal with on a daily basis, and so we'll try to dive into a variety of those issues over the course of the evening. So I got some questions. Y'all will have some answers. Some of you are also going to have to submit questions prior to this evening as well. I'll try to address some of those. We'll go for we'll see where the spirit takes us, but maybe 45 to 50 minutes or so, and then we'll definitely hold time for your questions as well. So Guy, I'm going to start with you. I don't remember much about my Series 7 exam from about 95 years ago, but the one thing that you remember is know your customer. And so I want to kind of ground the beginning of our discussion into what you all think about our data with your clients. So tell us, both a little bit about your firm, who's good enough to share some information about it. Tell us more about your firm. And as it pertains to ESG, tell us what your clients, what are your customers actually asking?
Okay, thank you. So we are an institutional money manager. So by and large, we're not dealing, at least not directly with retail clients. Can you hear me, by the way? Okay. So we are not dealing, we're not dealing with retail clients so often. So some of the marketing and rules regarding retail is just not as much relevant to us. But as institutional money managers, we're dealing with large institutions, whether they're pension plans, endowments, foundations, consultant community, and that's really across the world. So when we get ESG questions, requests, I will say it actually really depends on where it's coming from. Given the international client base, I would say that, the Australians, I would say Europeans, maybe I would single out the Dutch and the Brits as particularly focused on ESG issues. The Canadians are particularly focused on ESG issues. In America, it's a little bit less so, but perhaps I could give just a little finer point to this. So in Europe, it seems to be that there's a lot of focus when people talk about ESG. They really are talking largely about carbon and net zero type goals. Obviously, there's other considerations, but that's the conversation we're often having with clients, is about carbon reduction. I would say that the Europeans are leading the way in terms of regulation and rules and reporting. So there are all these things coming down the pipeline, which may change this a little bit, but the Europeans definitely are in carbon. I would say in US, it's more about ESG more broadly. And really the first conversation you have to have with a client is, what does that even mean to you? And I think we'll probably unpack that a little bit here, is what does ESG mean? And the role you have to play as, maybe more the informed party, is helping people define their objectives, so that, if they have objectives, you got to help them fulfill them. But oftentimes people don't know what they're even after. So, there is some education involved. So let me maybe just pause there on that.
Sure. So Aperio, as Vern said, has been part of BlackRock since for the last 2 years. And we have been doing what we refer to as values aligned investment. And so our clients span both the institutional as well as the ultra high net worth and high net worth taxable investors. And it's quite the spectrum. So when we think about ESG, it's about ESG data. And then how does that map into a client's values and or mission. And so the approach is around, it can be around climate change or the environment or social justice or animal welfare or any combination thereof. And so we start, like Guy said, is what's important to you? What's the world that you want to see? How do you think about it? Most of our clients are coming to us for a beta, so they are not looking to use their values or their worldview or ESG as an alpha generator. We can do that if asked, but that is generally not why somebody comes to us. We are a quantitative investor, much like Guy. And so we're using data in order to create an individual separately managed account for each client that looks like the world that they want to see. Now, BlackRock is obviously in every space and looks at this under the umbrella of sustainability. And where we fit in is under the auspice of choice and how a client seeks to do that, whether it is in what they own or what they do with what they own via proxy voting or shareholder engagement.
Ibrahim.
Awesome. I sort of feel like I'm either the bad guy in relation to these guys, the asset managers, or I'm the partner.
You're a client, so,
Yeah.
so you can.
Or that, or that. Marquette Associates, we're institutional investment consulting firms, so advisors to their clients. So pensions, Taft-Hartley's plans, foundations, high net worth individuals, universities, and so on. So we help our clients think through both manager selection, so where to invest in addition to defining their investment policy statements. As these guys have mentioned, a lot of that, we're at a position where we have more knowledge and we have clients with nebulous goals who don't really know what they want per se. And so oftentimes I'm leaning on managers and myself to try to help our clients define their IPSs. In terms of investment policy statements, in terms of what am I seeing from my clients, it's really, echoing what these guys have said around choice, around carbon, definitely like themes. If I were to bucket it, we have three kind of main themes. So we have some clients who really care about values alignment, so those are your faith-based investors who want to align with Catholic principles. So not only are they screening out their investments from private prisons and military contractors, but they're screening out abortion providers. So there's your faith-based investors who care about values alignment in their portfolio. Unions fall under that same umbrella where they want responsible contractor, labor-friendly portfolio companies in their holdings. Then there is the other side. There's clients who think about ESG as a way to manage risk in their portfolio. Climate change is real and there's good debates on, what is the impact of climate risk on the investment process and investment portfolio. And so we're seeing a lot of public funds, who are thinking, we have to preserve assets and returns for the next 20 years for people with college savings plans, for these states operating accounts. How can we ensure that those returns are protected in a high climate, low carbon world? So they're approaching it from the risk perspective. And then you have people who come to the world of sustainable investing to solve problems. They want their assets to make a difference in their communities, whether that's they want to be an anchor institution, a better place-based investor. They want their money to do something for the world. So like impact investing, private markets or proxy voting strategies in your public markets, really looking at director votes. And I tend to see a lot of those kinds of approaches in the very mission-aligned nonprofits, as well as high net worth family offices. So I'd summarize values, risk, and problem solving are the things our customers are asking us for.
And Ibrahim, let me say with you, when you think about that mix of what clients are asking for, has that mix been static or what has that evolution looked like even over the last few months or the last year? And then Liz and Guy, if you could provide your comments.
Yeah, I think the biggest evolution that I've seen has been on the conversation around proxy voting. Part of it is BlackRock really getting taken to task publicly for their proxy voting record, and really starting the conversation around, should asset managers be allowed to vote proxies at insurance companies and other high emitting sectors? This is one of the things that a lot of certain politicians are harping on this large institution about. And one of the things that I've seen, it's a very interesting dynamic because of that conversation. People who had never thought about how their asset managers were voting proxies are now just like, oh, maybe this matters, So I've had some clients who initially were in the values space who were very like, we're going to divest from fossil fuels, have a low carbon, fossil fuel free portfolio, because we want to reduce the risk of climate change and fossil fuels to the portfolio. We're now like, oh, this whole conversation about proxy voting, I think it actually might have an impact on the real economy when you replace directors of high polluting companies. So they're moving away from, I've seen this in few clients, moving away from just doing values-based screens, excluding fossil fuels, to I think rethinking owning these assets, but specifically owning these assets and accessing them through asset managers who are voting their proxies specifically against directors of these boards as a way to hold them accountable. So in a lot of ways, this ESG backlash against BlackRock has really created some interesting conversations that I've had with clients around incorporating proxy voting in ways that they probably never thought about before had the backlash not existed.
You're welcome.
Yeah. Thank you.
As the 20-something on the panel who's going to inherit the world,
Yeah.
I appreciate it.
Thank you, Larry Fink. So in terms of what the changes that we're seeing, I think we are seeing both sides of it, right? So people who are thinking about what their values are and how they want to express them and what tools they want to use to do that, and what are their choices, and how they think about that. The other piece that's been interesting, and part of it's because we're sitting at BlackRock, and part of it is just the world and the politicization of this whole topic, is the question that we get from clients. Well, I want the anti-woke version. I bet you can't do that. And the answer is sure we can. How do you define it? What does that look like? And how do we think about that? And so that's been a real shift in terms of that. Now, what hasn't really changed, we were just talking about this in the office the other day, the percentage of clients that actually follow through on this is, for us at least, no larger. There's a lot more talk, there are a lot more headlines, but at the end of the day, there is a group of people, whether they are faith-based or community foundations, and this is not Europe, because once you leave the United States, there are regulatory requirements that make it look very different. But within the US, that is just not the case. And so for us, the percentage, I mean, our business has grown, but the percentage of the assets that we see in the values and mission aligned has not changed significantly.
It's all talk until you cut a check.
It is.
Yeah.
Although one of the changes, it used to be that this is dumb investing. We don't hear that anymore. We hear other language and other words, but it is not, it is now accepted as part of the investment library, even if it's not what somebody wants to do. And I think that has changed.
Okay. Guy.
Yeah, so maybe I'll just add to that last point. I think it is, the conversation has shifted from making claims, and let's just be very frank, people were making a lot of claims that I think were not able to be substantiated, and that's where we kind of find ourselves today, that there is this backlash, and I think there's some egregious examples that people can point to and say, look, this whole thing is stupid because of these 6 things. And you know, that's not helpful. I think it's understandable, but you know, the claims have really been pulled back, and that's partially because of the backlash, partially because of, you know, the politics coming in, partially because of legal risk of greenwashing. So, you know, that's a reality that is, you know, I think the expectations have been really maybe reduced a little bit. And now, somewhat like what Liz is saying, we're seeing more discussion on customization. Okay, so now you have these objectives, how do you fulfill them? And, the objectives question is not clear, because if you even just think about the whole ESG endeavor, and let's just say this in the most kind of positive way, is the objective to make the world a better place with impact? Is the objective to reduce risk, which, this is University of Chicago, so, there is a framework for thinking about, risk as a driver of return. You take more risk, you get more return. If it's risk, is it a price risk? Is it a non-price risk? That's a whole nother conversation. And then, is it an alpha opportunity? And, for us, we're value managers. So our space is a little bit different. When I think about ESG from an alpha perspective, I think about pursuing the new innovative industries and technologies. And this will be an area filled with very interesting new innovative companies. So if you're a growth manager, you should be spending your time looking at EVs and renewables, because that's just where you'll see growth. As a value manager, I think about it a little bit more from risk. Am I going to face regulatory risk on the companies we invest in? Are the companies going to have high risk of asset stranding? Is there going to be additional CapEx requirements because they need to reduce their emissions? So it really depends on your starting your investment strategy, and then how does this fit in? And as a quant, we're in a, maybe a unique position because we're so data driven that we can be value neutral and just say, hey, tell us what you want. We will build you a good portfolio. Hopefully these constraints aren't binding. At this point, they're not so binding. So if someone said, hey, I need to be 30% lower emissions in the benchmark, not a problem. But if you say I need to be 30% lower and then I need to reduce it 10% each year, until, it goes to zero, well, probably in the next 3 to 5 years, that may be a problem, and you may have to actually make compromises on your portfolio. So there's also this time dimension that I think people don't account for, that now it's easy to make a promise, sort of like politicians are good at making promises today, and, in the future, the consequences will bear out. So, there is that element that, is happening. And then maybe the last point I would add is that when I think about our experience with our European clients, we're often dealing with people who have had a decision mandated from high above and imposed on them. And even if they're sympathetic to the kind of the idea, they're usually quite resistant to what does that actually mean in the reality of how they have to change their portfolio. Do we have to change it today? Why do we have to change it now, not in a year from now? So I think that's where the really where the rubber hits the road, is where a lot of these call mini conflicts are coming up. And then maybe I'll lie, I say one more point. We also manage money in West Virginia just as much as we manage it in California. So you can only imagine that whatever we do to please one is very much going to anger the other. So I would say that for us, we just try to stay out of that. We don't impose our views on the portfolio, but we're more than welcome to help, or we're more than happy to help clients reflect their views in the portfolios.
There's a lot. So we covered a lot there in like 10 minutes, right? So there's a lot to unpack. We'll come back to this concept of exit versus voice and some of the other issues. I do want to, all of you kind of touched on issues of data, here and there. And, anytime there's a problem, there are more than enough consultants out there, no offense, to help you solve all of your issues. And particularly, there's been a deluge, if you will, of consultants and data, specifically as it pertains to the ESG space. So maybe guys, starting back with you and going to my left, talk about how you're navigating the rush of consultants and data, and then maybe connecting it back to what your clients are ultimately looking for. Do you have good enough data to build the portfolios that you actually need?
So out of curiosity, is there any data vendor in the room here? Okay. I'll try to be.
Can you just like go like this for a minute?
I'm also a Booth student, so
They're
they're
right.
totally crashing.
Yeah.
So, so it's interesting what has
I'm with
happened.
Morningstar, by the way.
Okay.
Yeah.
So I also
Mhm.
bad about Sustainalytics.
Yeah.
We're with a different provider.
Yeah, you're great.
Yeah,
Yeah,
you're
you're
great.
great. Yeah, awesome. Yeah, yeah.
But, you know,
They'll give you a good price. Yeah.
so it's interesting because what you see with data, some of it reflects what has happened to the industry. The data vendors are actually becoming in some ways the consultants because there's so many items out there that even if you wanted to do something, you're scratching your head trying to figure out, well, here's one little silo that I thought I understood, but there's 600 items and I have no idea how to make sense. They all sound the same. They look the same. They have the same names. How do I make sense of this? So this is a phenomenal business for the data vendors. I think it's a great business for the consultants that are helping people manage this. Will probably be a great business for the accounting firms who will eventually be tasked with putting some real standards behind these issues. But I think with the data, the first important observation is that disclosure is still appallingly low. So here we are in this world where vendors are more than happy to report thousands of items. But if you actually ask, how many of those are estimated? How many of those are grabbed from, from a financial statement or, a 10K? Very few of them. And then you start asking the question, okay, well, are there standards? Well, yes, no, but you can kind of make up the standards. So, so already you're just starting with this very different environment that when I grab an inventory number, well, look, there's auditors involved, there's legal risk in how you display that on your financial statement. The vendors are generally going to show pretty similar numbers. Maybe they'll make small adjustments for things that, are kind of common sense. But it's a very different endeavor when you go and you grab ESG data because mostly people are not grabbing raw items. They're grabbing like a rating. And that rating is a product of hundreds and hundreds of decisions. And actually I have in my bag over there, I printed up the latest vendor methodology for the ESG ratings. 80-page document. And each of the components has like separate documents that then you need to go into in order to understand things. So I'll give one example of where I just see things kind of going off the rails. So if you say, take the universe, largest 2,000 companies, take the E pillar from vendor A, and that's their ratings on environmental factors, and there's a whole host of factors, and we'll go into that. So I was curious to see what industry had the worst E ratings. So, most people that are in this space should say, maybe it's coal, maybe it's oil, maybe it's, cement manufacturers, because, they're really kind of bad environmental companies. Well, the number one worst industry on E, according to this vendor, a widely used vendor, is regional banks. So
Those damn regional banks.
they're the problem with everything.
Yeah.
So what
They won't exist pretty soon. So then the emissions are gone. Then we're good. Yeah. We're cool then. Yeah.
But what is I think really interesting is that already with regional banks, there's the notion of kind of financing carbon. So that already is a little bit of a departure from the fact that you look at a coal company, you're like, oh yeah, well, I see what you're doing, so okay, I can penalize you for this. To now this kind of second derivative effect of, well, you're lending to these industries. So already it's a little bit of a tenuous relationship. And then the question is okay, so how good of a job are they doing at measuring the financing? So if you look at most of the most lowly rated banks, what you find out is that the reason they have a low score is that they don't have policies to address things that are not even issues for them to start with. So I was looking at a bank in Bethesda, Maryland, and it said, oh, they have no policy to address mining. You're a regional bank in Bethesda, Maryland, you're lending to commercial real estate companies. you don't need a policy on mining. I'm sorry, that's not a demerit. And you kind of go through this list and you say, this is a small couple $100 million bank. They don't have massive staff. They're not bad in the space of like a company that might be in Texas, lending to the oil industry. So, then you just start seeing that there's too many items and they can't even follow the thread to make the items that already are a little bit questionable make sense. If anything, you start, peeling back the layers of that onion or following that thread, and you start seeing that there's a lot of assumptions that basically don't even make sense to start with. So, there's good data items, and I'll say there are plenty of good ones, but when you throw too much, and this is perhaps the biggest problem with ESG, there's too many objectives, too many variables, that you devalue the whole exercise because you can't solve for everything, then solve for nothing. So data, I'll say, is mixed quality. But
Let's save the data vendors for us.
Sure. So I used to work at Morningstar. Let me start there. I spent the first part of my career at Ibbotson doing data and then at Morningstar. So and going way back when I was at Morningstar and sort of this colors my view a bit, we were told when we were starting to publish mutual fund ratings and we wanted to publish the portfolio holdings of a mutual fund. And we were told both by Fidelity and the industry, as well as other people, well, nobody cares. Nobody needs that. We're not giving it to you. We published anyway. It was just blank or it was old. And eventually you sort of end up in what I considered to be a virtuous cycle, right? You published old stuff. People didn't like it. They started delivering it and the data got better. So that is through one lens. And I think that is happening on the ESG space. It has gotten better because there's a light being shined on it. The other part that I learned when I was at Morningstar is about ratings. And people would yell about the 5-star ratings and they were not representative. They're not right for everybody. That wasn't what the methodology said. And it wasn't what we ever said. And so you learn fairly quickly that you have to go under the hood. You have to look at the methodology and you have to be an informed consumer. If you take the shortcut of building a 5-star portfolio with just 5-star funds, you're probably not going to end up with a particularly great portfolio. It might be the fastest, most expedient way to get something done so it looks good when you hand it to a client, but it's not the smartest way to go about it. So I think we have an issue, and Bert, you introduced and said Booth is the #1 school, right?
Says who?
Says who and why. And for Guy, this may be absolutely the #1 school. For my husband, probably not. Why? For whatever reason.
Well, your husband's wrong,
He is.
right? So, I mean, for the record, yeah.
He's a lawyer, I think, at one of those schools, from one of those schools that is no longer reporting data to the rating agency, but nevertheless. So I think as people have gotten smarter about asking those questions and looking under the hood. From an Aperio standpoint, we actually don't use the ratings of any companies. We use all of the raw data underneath so that for our clients, we are constructing something, 1, that we understand, 2, that makes sense, and 3, that we can be really transparent about. I will give you just a very specific data example. We had clients asking us for a way to reflect their concerns about racial justice and racial equity in their portfolio. And there wasn't data. And there were all sorts of reasons that none of the data providers were making that available. We're looking for racial and ethnic composition of boards. And that data did not exist. We spent a lot of time talking to all the vendors. We understood why it didn't. But our clients wanted it and were willing to accept all of the gaps in the data and some of them were, some of them weren't. And we ended up with a data vendor who had some of this data in the background and was willing to sell it to us. They were not willing to give us anything. They were willing to sell it to us. And what we did was we explained to the first client that wanted it, that the data was imperfect. There were 5 or so types of data in there. The first one was the company disclosed. Okay. So that was good data. The second group, and there were very few of those at the time, The second group said, we're going to triangulate. If John Rogers is black or Melody Hobson is black on the Starbucks board, we are going to assume that Melody is also black over on this board. That seemed relatively safe. That was some percentage of the data. And then they went and they looked at bios. Well, if this person is part of a black fraternity, we're going to assume they are black. Starts to get a little sketchy. And it went down, but it was all disclosed. So when we talked to a client, we said, look, not great data, best we have, directionally, perhaps helpful. We had some clients who said better than nothing, we want it in there. And we had other clients who said, not comfortable with this. And we didn't. Data's gotten better, but it was a way to shine the light on it. And disclosure and proxy voting start to get at some of that as well.
Got it. Hebring.
The other two panelists have really made some good points. Let me try to think on things that I can add to that. You know, first question, how do I deal with like all the data providers? I don't. It's very overwhelming. I get a message every single day from like probably 3 being like, oh, MSCI sucks, Sustainalytics sucks, here's a way we're better. And I'm just like, I don't know how to do this, you know? It's very overwhelming. All of the data vendors trying to compete and try to sell consultants, advisors, asset managers, asset owners data. I think some high level principles that I've tried to take when approaching the data conversation. I think principle 1 is that when we're evaluating managers, we don't want managers to just take the best rated MSCI, you know, to build a portfolio with what MSCI says are the best rated ESG funds. Because like what ExxonMobil is a top rated ESG fund company because of their diversity and their corporate governance and so on. But I don't know, I feel like some people wouldn't really agree with that for other reasons. So our approach is to, I think, say like to managers when we're evaluating them, you know, don't just rely on the ratings provided by MSCI Sustainalytics. Look at the raw inputs, and we want to see that managers are forming their own opinions, using that underlying data to come to conclusions on, you know, what is a risk, you know, is this a material risk, is this an alpha opportunity, and so on. And, you know, coming back to this question about like, you know, really interrogating the methodology. When we're talking about environmental and social issues, I'll ignore governance for a second, like environmental issues, like what is a just transition? You know, what does it mean to be diverse, right? Like these are like very like thorny questions that like people can have like very strong conflicting opinions. Take diversity, right? When you're looking at a company, you know, is it a diverse place because the owners are diverse? Or is it, you know, is it based on promotion inside? When we're talking about diversity, are we only talking about African Americans and Hispanics? Or is disability part of that, right? Like there's very real debates around, you know, how to assess these very real human issues around social and environmental issues. And because of these, how difficult it is to form opinions, and it's just part of really, I think, living in the world. Is why you see this data, you know, there's so much, these ratings do not converge. You know, what MSCI has and what Morningstar has and Sustainalytics has, their ratings don't converge and don't align because it's people using their own biases to form opinions on these very like hard intractable issues, you know. And so I think my view when I'm evaluating asset managers, you know, like I'm not going to pretend to know what's, you know, you guys know your company's the best, better than I do on the advisor side. Like we're not looking under the hood that way. I just want to see that you guys have resources that's forming your own independent opinions on what you think on an environmental, social, and governance issue is either a risk or an alpha generator, because these problems are hard. And it's important, I think, as you guys said, look under the hood and really have some independent oversight on these issues.
2 points I want to make, and then I want to talk more about environment. First, in terms of numbers, for if you're not following Professor Christian Lloyd's research, particularly in terms of how you count carbon emissions and how companies are counting carbon emissions, I would highly recommend that you do that. He has both written several papers on recommendations on how do you do the count. He has also written in the Chicago Booth Review on this as well. If you don't feel like sitting down and reading 50 pages of a white paper. The second point is I taught a class. My background is mostly in environmental policy and politics. And so I taught a class this last winter called The Political Economy of Climate Change. One of the things that the students had to do, their final project, was actually do an analysis of the carbon emissions and the carbon strategy of a firm. And we picked, I only had them pick firms that have received an A or A- rating from the Carbon Disclosure Project, right? So these are, the top 150 or so firms in the country around these issues. And I think we had 13 projects, and we saw basically 12 different methodologies, including 2 different methodologies from auto manufacturers. And that is actually raw data, right, coming from them. I think we'll have a little more to say about the regulatory front and potentially what the SEC has to say on these issues in a moment. But let's stay on the E side. Liz, let me turn to you first. There are a lot of terms being thrown out in E world. Decarbonization, net zero, blah, blah, blah. I'm curious about, in the buzzword bingo of your customers and your clients, what are they looking for on the E side? Do they have a marker that they're actually trying to get to? And knowing that it varies by your customer base.
Not really.
Awesome.
Because it is so dependent on where the client is coming from and what they've read, and if it's a foundation who's on their board and what language they use. So we hear net zero coming sometimes from foundations and endowments, more on the institutional side. We don't really hear it on the retail side. It's not how they think about it. We hear about the intersections of that, right? What are the impacts on the most impoverished? Like, how does that string through? So it plays out very differently. But we are not in our part of the BlackRock world.
Got it. Guy, you're writing feverishly, so you'll have a great answer for us.
All right, so I would say that I don't know if this is a exhaustive set of considerations, but carbon's kind of first and foremost. If you just look at the words that come up, water stress and biodiversity seem to be second. Then you hear a bit more, I don't know, package waste and land use. I don't know.
Circular economy?
I actually don't hear that as, I get that notion, but I don't hear that coming to the forefront as often. But I would just say, let's even just stick with carbon. And I'll highlight a couple key decisions that one has to make. So first of all, you have a question of, is it disclosed? Is it estimated? How is it estimated? In the world of looking at financial statements and looking at inventory is always disclosed. We internally, when we talk about data items, we don't like mixing estimated and disclosed items. We're either grabbing everything estimated or everything disclosed, and we kind of decide how to combine it. But the vendors often mix the two. So that's a problem. Second of all, if you take the notion, and I'll assume some understanding here, has anyone heard the term or not heard the term scope 1, scope 2, scope 3? Okay, so just think about it as a continuum of your emissions as a function of kind of your business. So let's just say collapse scope 1 and 2 to say that's the emissions that you are kind of directly responsible for, either from your utility bill or from the big steam stack that's emitting whatever into the environment. So that's kind of scope 1 and 2, and scope 3 would be everything up and down from your supply chains and customers. So if you're a grocery store, you should account for the emissions to get the goods to your store and from your customers driving to your store. So scope 3 is a double counted number, because if you add everything up, you're kind of counting things twice. So scope 3 is just, there's very few standards around this. people are kind of trying to force this to be used. I see it as just, it's too early to even discuss because I don't know how to make sense of it. So, you know, some people want to include scope 3. You might have a completely different universe of what are the best companies and worst companies. If you include it, most people are not including it yet. And then the finer point, which is really actually a very nuanced one that people don't appreciate, is you typically scale these items by something because, you know, you want to kind of say, how much emission do you produce per what, per something? So if you're thinking about a utility company, it might make sense. How much emissions do you produce per how much energy you produce? So, you know, maybe you're more efficient. That at least makes sense. But if you think about I don't know, Foot Locker, like a retailer. Okay, so you have a scope 1 and 2 number. What do you divide it by? So if you divide it by sales, which is kind of they call it intensity. You know, on years where maybe you had more sales, you should have more scope. Years you have less sales, you should have less scope. Okay, so that was in some ways seemed to us to be the gold standard a couple years ago. And then people said, well, we don't actually like that. We want to scale by, you know, there was some discussion of market cap. Now everybody is scaling by enterprise value. And the goal there seems to be they want to compare their fixed income portfolio and their equity portfolio at the same time, which I don't even know if that makes sense, but let's just say that's what they're doing. So then you say, well, you're scaling by scale by enterprise value. Well, now you're kind of scaling by valuation. And I take offense to that as a value manager because you're actually, you know, if you're a company that has a very, very rich valuation, you're going to divide by a very small number. So you're going to take a company that actually might have a lot of emissions, but because investors are going to pay 10 times sales, it actually looks very small on this measure. So, you know, already you start inserting a bias based on which item you scale by. So we had a client who is net zero committed. We had discussion, we said, please, here's a bunch of reasons why when you look at us, you should look at it by sales. Thank you for your feedback. We understand it. We're going to scale by enterprise value. What happened? They did this amazing job reducing carbon emission. You know, then stocks dropped. Oh my, our emissions went up. Like your emissions didn't go up. Your denominator went down, so your emissions went up. So now they're sitting there with heads on fire making, you know, because they made a promise they're going to reduce emissions, but their numbers are higher. I said, well, you're scaling by something that moves with the market. It's the changes in this variable is more because of the denominator, not the numerator. So, you know, I know that these are kind of geeky, like nuanced points, but real.
Do you know the audience that you're talking to right now? Like you're in a room full of geeks. Like
they appreciate it, but it makes real impact on how you build a portfolio because these can be really impactful decisions, but people say, I don't really want to be bothered to, you know, as everyone has said, read the methodology or understand why A might have some advantages and some disadvantages. It's like, no, let's just divide by EVIC. We'll make it all simple. We'll divide, you know, so that way we can look at everything in the same. So.
But I think all of that is true. And we certainly have clients who get that far into the weeds. What we see more often, because we're not using it as an alpha or the other side, the risk side of it, they're looking for something directionally that aligns with where they want the world to be. So it's not disjunctive with their values. And so, yeah, we can go really deep and look at all of these pieces, or you can stay a little bit above the fray and say, am I directionally headed? Have I expressed what's important to me? And am I getting that back? And I think there is always, you know, don't let the perfect be the enemy of the good, which is easier said and done in a passive quantitative portfolio where you're looking to align with values than where you're making a promise or aspiring to deliver outperformance. And so I do think it's important not to, that sometimes, depending on what the client is trying to do, you don't get so lost in it that they're like, oh my God, I can't do anything.
Ibrahim?
I think that's a great way to tee it up. Like, you know, I can't imagine a situation with any of my clients or the IPSs that I've constructed and the reporting we've done where any of my clients have really gone into like the weeds of carbon accounting, you know, like maybe at most like I've seen some, I'll put this out there. None of my clients have a net zero commitment across foundations, public funds and so on.
If they don't have that, then what are they looking for if they're not going down the scope 3 rabbit hole?
Most of them, to what you were saying, directionally aligned,
Got
like I've seen like in their IPSs, how we've constructed it, we try to express the values, very vague. Like making an example, there is a public fund that I'm working with. I can't disclose the name. The public fund is like 20 feet below sea level, and so as a city, this public fund is accountable to their city council. Climate risk is very real for them. And so in their IPS, how we've constructed it, we're like, okay, in the investment process, we want our managers to have an opinion on how are they trying to manage climate risk, and they've defined climate risk very specifically. Climate risk to them is physical risk, the physical effects of climate change, so when we talk about climate change, it's mainly being felt in heat and water, right? Like, climate change gets worse, we have droughts, you experience heat, or it's water, you have coastal flooding, right? Especially for this place, it's below 10 feet below sea level. So they're like, we want to talk about physical risks. And then the other side is transition risks, policy, regulations, technology, and consumer preferences, right? They're not asking any of the managers in this portfolio to report specifically on like, what is the heat intensity of your portfolio, or what is the exposure to flood risks in 50 years, doing climate value at risk. I know tools exist that do that kind of like long-term projection. They're not really asking for that kind of granular reporting. They've kind of just asked us, as me, who's doing all the evaluations for managers for this portfolio, is just to ask each manager, how do you think about physical risk in the portfolio? Is that part of your decision making? If you're buying like an agricultural company and it's like in an emerging market that's prone to like, droughts, India, Pakistan, how are you thinking about those factors? And we just report back to them being like, oh, this manager who was in this search, here's how performance was for this manager. Here's how performance was for their competitor. This is what they said to me about how they're managing physical risks. So as you're getting at, it's less so for the stuff that I've worked on, less so direct, getting into the weeds on carbon accounting, so many ways to fudge those numbers. More so just values, trying to see, are managers integrating these climate considerations around physical risks and transition risks into the investment process. And I think, like I was getting at before, these are very hard problems. I don't think any of us have the answer on how to avoid climate disaster. And so it's really,
I had it in my class. If you would have taken it, you would, yeah.
Wonderful,
so, yeah,
wonderful.
yeah. So-
Write me a letter of recommendation.
Yes.
I didn't go to Harris,
Yeah, well, yeah.
but
Okay.
yeah. So it's more directionally trying to just understand, are managers thinking through these issues from a process perspective, and just trusting you guys to do the best you can.
Vern, one thing maybe we can do as a follow-up, since a lot of folks I think had questions around scope 1 versus 2 versus 3 emissions, I can provide some of the readings and videos I shared with my class. We talked a lot about this issue, and one of the reasons I'm happy to share it is because the SEC is going to let all of us know potentially in the next few weeks, minus some likely court challenges, what scope 1 and scope 1, 2, and 3 emissions means in the United States. So it's going to very much become a hot button issue. I'm going to ask one more question of the panel and then turn it over to the audience. But Ibrahim, I want to go back. You teed up. You tried to fight Liz in your first answer in talking on issues of divestment and also issues of voice. And I want to hear more, both from you and from the panel in general, about how the traditional kind of concept of filtering or screening and really kind of articulating the idea around shareholder democracy is something that my boss Luigi Zingales has written extensively about, this concept of exit versus voice. You saw a lot of bluster around engine number 1 last year as well. So what are you seeing on the customer side in terms of what on what customers want and what are they actually willing to, maybe part of, to guys' point earlier, what are they actually willing to do about it?
Yeah, there's one of the things that we said earlier in this panel is that like a lot of the asset owners who invest their money are still figuring out like exactly how to execute these goals, putting it in buckets, right? There are the people who want to divest from fossil fuels, who want to divest from name your boogeyman. And then there is the people, the asset owners who define in their investment policy statements, if we're going to compare between manager A, B, and C, and all things are equal in terms of performance, beyond that, we care about ESG integration, or we care about, active ownership, stewardship, proxy voting, however you want to call that, and I've seen quite a few foundations start to incorporate that language. In terms of, I think, like the conversations that I've had with my clients on how to think about these two things, on the divestment side, most of the people are thinking about divestment or engagement as a tool to affect social change. Part of it is reflecting values, part of it is to preserve, reduce tracking error and so on, but it mainly is used as a tool to affect social change. On the divestment side, the argument goes that if you divest these holdings, you're able to revoke the social license of fossil fuels to operate, similar to what was done in apartheid South Africa with the divestment movement then, before sanctions came in, So what I've said to clients who wanted to go that route, I'm like, okay, like you're going to experience tracking error if you're going to pull out of fossil fuels, you're going to be underperforming because energy has been the best sector right now. But if you're going to divest, you better tell people about it, because the whole point of it is to reduce the social license. Don't just divest and like, walk away and never say anything. Like, tell your PR folks, tell your communications folks, let the world know that you as this institution with this much assets have made this decision and now revoke that social license, and I think a lot of clients, I think, forget that point, the social communication, because it's about changing the political dynamics, but then the criticism of divesting is, it's just changing hands, secondary market. If I divest, someone else is just going to buy. It doesn't really affect corporate behavior.
Divesting is the quiet quitting,
Yeah.
financial markets, if you will.
Yes,
Yeah.
absolutely. And so, some of the asset owners have started to like ask about proxy voting, and we've actually been doing searches in relation to managers where we've been evaluating managers based on their proxy voting, where I have fallen on my decision on where I think on what makes good proxy voting to most align with client values. And this is the messaging that I've shared with clients, is that it doesn't matter in my mind how many engagements you do. Like, I don't want to see the number of engagements you've done or the number of shareholder resolutions a manager has voted for, because at the end of the day, these resolutions are advisory in nature, and sometimes these resolutions are used in court cases to justify like not doing any climate work. So Chevron right now is defending themselves, I think, or Shell, one of the two, is defending themselves in court. They're being sued for not abiding by like their clean energy commitments, and they're like, we are, a shareholder resolution was passed telling us to do this, and we supported it. So we've kind of taken the view that number of engagements, shareholder resolutions doesn't actually matter as much. Where I think the rubber meets the road is on how directors are being voted for. I think the biggest way that a shareholder can affect change at a company is whether they vote for or against a director. So we're going to be looking at the directors of audit, how asset managers are voting for directors at audit committees. If there's a sustainability committee, how are they voting for them? If that company has put forward a climate plan and, an asset manager deems that plan is not having enough targets, progress being met, so generally our clients are asking about like proxy voting and stewardship, and we've been advising them, saying the thing we're going to look at most is director votes.
Liz?
So From an Imperio standpoint, we offer clients as part of their ability to reflect their values in a values aligned account or in a non-values aligned account. We have 4 standard proxy policies to allow them to express that. One is a traditional SRI, so socially responsible. The other is good governance. We have a Catholic, and we have a management aligned, which came about more recently because we had clients who said, I don't want any of that nonsense over there. We put the CEO in place, the CEO knows what they're doing, and I just want to go with that. So be it, your account, your choice. That's how we vote. We also have clients that we work with who have more nuanced views, and we create custom policies for them as well. The other way that we allow clients to further express their values is around choosing to use their shares to file resolutions at companies around issues they care about. And that has been a growing part of our platform for our clients. We basically act as a matchmaker. The client cares about, ocean plastics, and they want to file. We have a partner. We have 4 or 5 partners now who are doing research and are advocates on this topic. Think Starbucks and straws. So they look to us to say, we would like to match up with a client who is interested in this issue and has the requisite shares, and they will then use their shares to file the resolution. We do hundreds and hundreds of these now on behalf of our clients, all under the auspices of choice. And so I think, as Ibrahim said, this is a growing tool that is being used, but I do think it is at a point where it is a reminder to everybody that as a shareholder, you have rights, and those rights can be used or not. And that is also a choice. And I think for a very long time, investors forgot that they had that responsibility, that privilege, and that right.
So I would say that the clients that care most deeply about these issues are probably already voting their own proxies, at least for, with us. Now we have clients that, delegate to us proxy voting responsibility, and like many in this industry, we outsource to one of the proxy voting services. Historically, there was one standard, as Liz says now. They have 4. I don't know, there might be 10 for all I know. I don't know how many, I don't know what the array of options are, but for us, we had one. That's what we had always used. We said, how do we even know how to decide? We own, 3,500 companies all over the world. We know very little about them. That's not part of our investment process. So how could you expect us to know what to do with the proxy voting? So, what we have done over time is now we have a secondary option that clients can elect, more of a climate friendly one. The irony is that the 2 are nearly identical. So I think it's really more smoke and mirrors that the proxy voting services are saying you have all these choices, but at the end of the day, they're correlated 0.99. So I don't know if it really does anything besides appearances. But we did get a lot of pressure from clients that really care about proxy voting and say, well, we actually want to see you vote all your proxies, not just ours, in this way. And that's for us a very, first of all, the answer is no, we won't. But it's a very difficult position to be put in. So what we concluded, I think, internally was, look, as a quant, we depend on data. The data in this area is not great, and disclosure is not great. So we actually got really comfortable with the notion of, if we're going to do any type of engagement, we should at least engage on the topic of disclosure. That's not a values. That's not me imposing my view on you. It's important for us, perhaps in our process and our signals, but also we're being asked to report metrics to clients. And how can I report a metric that I don't have? So I think that, we would love to see clients not ask us to divest. They always ask us, well, tell me what would be the impact of not owning fossil fuel. And it's like, look, I'm a quant. I make predictions all the time. That's what I do, is build models. But I don't know what the model is for if energy does well, you're going to underperform. And if energy does poorly, you'll outperform. I don't know what energy companies are going to do. If I did,
I would have probably a different investment process, but I don't. So, everybody wants to do these things and think that there's no consequence to it. Now, there was, I think at the end of last year, and I hopefully have the details right, but I think this Vanguard pulled out of the Asset Owner Alliance.
Yeah, they did.
And the CEO basically said, he said, it would be a lot of hubris for us to presume to know how to vote and all the issues pertaining to all these companies. It's not our job to kind of impose our views on companies. So, that was like a really big, I think, kind of reversal of direction for, I don't know what Vanguard was doing before, but it seemed like there was this, everyone was rushing in, everyone was making these claims. And then all of a sudden people are stepping back and saying, actually, maybe we don't want to be in this position now. That might be marketing, that may be pressure from clients. There could be 1,000,001 reasons, perhaps even conflicting with each other as to why they did that. But I think that you're seeing that managers don't want to be in a place where they have to impose values, because it's a really thorny issue that you're going to offend someone in the process. And as an industry, the last thing we want to do is offend our clients. We want to help them out, and hopefully they stay with us.
I do wonder how much, if you look to the Y, if you look to the state capitals of West Virginia, Florida, Texas, and a handful of other states, if that might have provided an element of motivation, if you will, around that. Questions? There are a million things we haven't talked about yet. Yes.
To what extent are you aware of investors who are trying to figure out the different ESG methodologies to speculate on what companies are going to get tagged the most in order to take the other side of the trade?
Rating arbitrage. Yeah, look, I would say that from what we noticed, the really good ESG companies, and I would say it's probably the best ESG companies tend to be rated the best by most of the vendors. I think you have a lot of more disagreement in the middle, but oftentimes the best and the worst kind of seem to align.
Well, what I meant was not among different rating, but who's getting tagged the most.
So what I was going to say is that those companies, you did seem to see a premium to their valuation vis-a-vis competitors. Now, as an investor, I would say, well, is it worth more because it's a more valuable company, or was there just a flood of money coming in that was directed in this fashion because of a secondary objective? So, as a value manager, I invest in companies that typically have problems. That's why they're cheap. They're in bad industries, bad company, bad management. And the whole point of that is that you should be able to unlock value by making changes. So it's not always clear whether the worst company on a metric would be a bad investment. So, we actually look and say, I don't know what to do with a coal company. Those are universally hated. There's no loved coal companies, but you see that it reflected in the multiple. So the question, this is University of Chicago, is what's priced and what's not. And there was seeming to be somewhat of an influence on valuations that was rating based. And perhaps you're seeing a little bit of a retrenchment, but these things are very difficult to disentangle.
Liz, Ibrahim, anything to add?
Nope.
Other questions? Yes, in the back, and then we'll go here.
Lots of discussion today about shareholders, but there's also more recognition, the concept of stakeholders today. Just wondering from an ESG perspective, what sort of fiduciary duties are owed by your firms or industries to the stakeholders?
And how would you define a stakeholder? Like, can you give us an example?
That's the ultimate question. Yeah.
You exist in a community, and communities are arguably sort of stakeholders in the companies. The companies are existing, and there's a refinery. What sort of ESG duties are owed to the stakeholders, if any?
I'll start because we punt on that. That is all client driven. So if you are a Native American tribe and you view yourself as a stakeholder to that company, you may look very differently at that issue about the pipeline or whatever's coming into your neighborhood. we don't take a position as a Perio on that, but our clients certainly do. I'll give you one example. We worked, and this is public, we worked with the Cleveland Community Foundation, and they were looking at their stakeholders at the Cleveland metro area, at their citizens. And so they built a portfolio that aligned with their values and their mission to drive economic development, to have racial and gender inclusion and other things within their community. So their IPS, their social profile, very much reflected their concern about their stakeholders in that particular case.
I can kind of say it's the similar thing, you know, it's very much, it's very client driven on who they define as their stakeholders. Like one, you know, keeping it vague, like there's one like university I know who we're going through this exercise with them where they were like, yeah, like students are not our stakeholders. So student groups who are coming through saying, let's divest the endowment from fossil fuel, we're not accountable to our students. You know, we are accountable to the investment team, we're accountable to the board. You know, these kids are going to leave in 4 years. It's okay. You know, so they've taken that position that like, I'm not, you know, my fiduciary obligation is not to these people, these stakeholders, you know. I know of a community foundation who we've worked with who, you know, similar to what you've described, very focused on being an anchor investor, place-based investor. They're like, we care about our local community because we're a foundation. We're doing all this grant making, you know, and so it's out, you know, it's out. It would be a violation of our fiduciary duty to not think about how our investments help our local community, given that that's our purpose, you know. So part of that, you know, like let's have our bank accounts located with a credit union. Not all of it, but some have some cash there, right? Others is let's invest in, you know, bond funds so that those bond funds are giving mortgage backs, you know, are mortgage backed securities. So they're trying to expand home ownership to minorities in the community, right? Let's invest in like asset managers who are located in a certain zip code or who are in my region, you know. So this community foundation decided that because they're a mission aligned organization whose grant making is very much community focused, they also had a fiduciary obligation to think about how their investments, which is a bigger size of their portfolio, greater than their grant making, could help their community. So to what you were getting at, I think people can define stakeholders as vaguely, and you know, who your fiduciary obligation to is as nebulous as one can make it.
Got anything to add?
Yeah, when I think of ESG, the E and the G are, you know, we can quibble, but pretty good understanding of those. The S is an area people really struggle to define and understand. And, you know, I don't say this cynically, but to me, the S really reflects stakeholders. Because when I look at how companies are rated on S dimensions, it often is at this kind of juncture, this tension between what is the purpose of a company. And I think that that's the area where I think we have as a society just vast disagreement as to what the nature of a business should be. And once again, we're in Chicago, and you know, your works and Gall's work, Milton Friedman's work before it, you know, discuss this. So I think that I have issues with some of the S items being thrown into this matrix of ratings, just because I think inherently that's a little bit more reflecting politics than what I think are more kind of universal values. So I probably would prefer to see less of that. But I think that we could all, once again, University of Chicago, Milton Friedman, externalities. We should all not aspire for a world where you can externalize your cost on society. That doesn't, you know, I as a manager am doing a great job as a manager if I can take all my cost and just impose it on society. I raise profits. That's a great thing for a manager. It's a terrible thing for society though. So, you know, we should care about, you know, pricing externalities and not allowing people to impose externalities. But that's
that's a difficult one. So I think some of that's in the eye of the beholder as to, is that an externality and are you imposing that on me, or is that just kind of business as usual? And
So do you think at a policy level, there's sort of a responsibility to promote ESG as more of an ideologically neutral societal objective? Is that where you're kind of going with that?
I think,
Sort of like,
that-
let's not argue about it. Let's just,
yeah, I think if we wanted to make progress on some of this stuff, I think that if you think about it from an externalities framework, and I think you could find more common ground that, we will find plenty to disagree about, but I think you'll find more common ground with just that framework at looking at social issues as some are maybe the obligation of the business, but I don't feel like if this is something that is the government's responsibility to solve, and governments are doing a terrible job solving these problems, that it should necessarily be the company's responsibility to do what the government can't. So,
You know,
yeah.
the one place where I think in the E conversation, the stakeholders start manifesting itself in a very real way. Kind of going back to the accounting conversation we had about emissions, is scope 3 emissions, right? So scope 3 emissions for a car company are what happens when the car gets driven off the lot, right? Does Ford or General Motors or whatnot have to account for that in their accounting? From the perspective of the firm, like, no, you went and took the damn car, right? Those are your emissions. From the perspective of society still cares about that emission, right? And so when thinking, and so this is when hard questions start getting asked, right? And this is something
like, cars have rounded curves now because there was, they said the cars to be more aerodynamically efficient.
yeah.
Cars they no longer have sharp angles.
Yeah, so the complexities of this kind of manifest itself even in the easy part of ESG, which I think sometimes we think about the E. Yes, go ahead.
So I want to talk the G. Other than what we've already touched on, what are the topics you think about? There's bribery, corruption, trade sanctions. But what about sort of more common governance issues like conflicts of interest? What about other types of things that are happening to corporations that maybe the focus of government, like cyber?
And can I expand that question just slightly? Are there differences, particularly in terms of your non-US clients, on those issues? Because you're seeing supply chain regulations come in Europe around issues of wage theft and slavery as well.
It surprises me in our little part of the world at Aperio, we don't hear about it often at all. And we raise it fairly regularly. Like, if you care about the E, the G matters. It occasionally comes up, like when Wells Fargo or Volkswagen, and those things tend towards corruption. They're not going to show up anyway. Those are just, it's fraud, right? But you raise the other issues, and we raise them with clients as a way of connecting the pieces and better managing them. And you get these blank stares like, no, that's not what I mean. So no, unfortunately, we don't see it as a general matter.
Guy, Ibrahim?
I think that originally the G was the Trojan horse to sell ESG because everyone could kind of get on board with G and said, hey, this is all good stuff. And it allowed them to kind of take the thinking of how they think about G issues and almost like put it in other domains. Now you don't hear anyone talk about it. So if they say, hey, what are you doing about ESG? And you say, well, let me tell you about all the things I do about G. They're like, well, actually, I don't really care about that stuff. So I don't know. Look, it's what managers should be doing anyway. And it's not clear to me what is good governance and what is bad. I mean, let me rephrase that. I think some things are clearly good governance, some are clearly bad. But what is the investment implication? Once again, you might have a great company with terrible management. They're embedded, they're corrupt, they do, whatever, related party transactions, but it's a good company. Well, if we can take over this company and kick the management out, we might actually have a really good investment. So, it's not just that good government or bad governance is something to avoid. You may be actually an opportunity, because once again, some of these things get unlocked by making the changes. governance is probably way easier to change in a company than the basic reality that an energy company is an energy company and you're asking it to reinvent itself as something else. So.
Unless the bad governance is the culture.
Right. Yeah, if you have poison pills and you have golden parachutes and you can't do this.
Yeah.
Well, I think you mentioned Engine One before. I do think Engine One and their votes have put the boards on notice. And a reminder to all of them about what their responsibility is to the owners of the company who are the shareholders. And my guess is fast forward a couple of years, people have probably forgotten, but at that time, you did see board members start to sit up and say, in my own self-interest, I want to keep my seat. So I need to think differently so that I don't end up in that same situation.
The governance is not just, so just one thing, the governance thing is not just for US investors, international investors, it's actually different companies. Because I don't know how to think about a Korean company in the same framework as an American company. Korean companies have, very complicated cross ownerships and such. Families are involved. It's bad governance by American standards, no doubt about it. But it's also it's a different standard for a different place. So, sometimes just different standards have a way of sticking around.
It's all fun and games, so you start messing with the table. Yeah.
Yes, then you're done.
I'll keep it short and simple. I've not heard many of my clients ask about G issues, candidly speaking, there is stuff around like executive pay, right? Like people have asked about that. People have asked a lot about like board diversity, and like I've had clients who wanted to look at how different asset managers vote for diverse boards. How does that differ in the United States versus in India versus in Korea versus in South Africa? In India, diverse boards, there's issues around caste. So wanting like diversity of caste in India, but like in South Africa, it's like not about having majority blacks on the board. It's about having women and so on, and like other ethnic groups, right? So I've seen some clients ask about proxy voting policies as it relates to like diverse board members. And even, at least in my mind, I feel like the whole proxy voting conversation, yes, it's around, as I've spoken about, around climate change. Those are all governance issues, so I've seen that show up as opposed to like traditional governance issues around like anti-takeover, corruption, and so on and so forth.
So it's E, then S, and then like G.
Except when G is around E issues.
Yeah. Oh, okay. Then
Yes,
the
no,
GE, if you will.
None of like the stuff that like everyone learns in corporate governance 101. It's the governance issue, shareholder rights as it relates to E&S issues.
You could play a really fun game by throwing out like topics and then saying, is it an E issue, an S issue, or a G issue? And people will look at the same issue and be like, no, that's S. I'm like, no, that's G.
I'm going to do that with my students.
W.
Yeah. Yeah. Harold.
So how does doing an ESG versus non-ESG can you affect return, assuming the same level of risk? And do your clients give you expectations? Like they say, well, will it be the same, or we don't care if it's a quarter point return less or something like that?
What does the return look like, and what is the expectation of that return?
Good gather.
A lot of empirical studies give all sorts of conflicting results, so I think it's a mixed message.
So we measure it, and I think you guys do it very similar, like we're quantitative managers, so we measure it by a statistic called tracking error. And so that is knowable to some degree. You can measure by, what is the deviation from the benchmark you have chosen, given the constraints you are putting on it, whatever those constraints may be. In the case of this conversation, the constraints may be a divestment, it may be a tilt towards certain things. And coming out of that, you have some sort of tracking error measurement. By the same token, if we weren't having an ESG type conversation, those constraints could be a value tilt. It could be, a country bias. All of those things are deviations from the accepted benchmark, whatever index you have chosen, and if you choose a different index, you will get a different tracking error. So these are all subjective choices that clients are making across the stream. And from that, you have to accept each of those assumptions. And then you get a statistic that tells you what your deviation will be, which could be positive or negative depending on the situation. So
Well, you might get paid. I mean, there are other factors.
all of those can be controlled or constrained within, again, we're quantitative investors, so we are using some tool and optimizer and risk models. And so these are constraints within that.
By definition, the second you impose a constraint, you've made it a suboptimal solution. You've made it optimal given the constraint, but kind of pure portfolio theory is you can't add a constraint and have a better portfolio.
You can take a different benchmark and then you can get zero. And that's what ETFs do. You buy a benchmark, Morningstar, you buy a benchmark, and then you deliver beta to that benchmark. But inherently in that benchmark, there is a choice around what you're seeking. If that makes sense.
Ibrahim, anything?
Yeah, I mean, on what she was getting at on tracking error, like, there's people who do like highly customized screens. There's Aperio, does it very well. There's parametric.
Yeah.
I'm not gonna lie, I'm actually
Guy, you do it well as well. Just, I want to be clear. I want to be clear. You're doing a great job.
When I was trying to like key up, so like the two people who do like institutions who do customizable screens, Aperio and parametric. Like you get a menu and you can like remove and exclude and so on. And like I'm actually literally doing this in a few weeks with a client where we've asked them both to like give us like, here are the exclusions we have and just compare the tracking error based on S&P 500. How are those benchmarks going to look a little different, and just being like, oh, here's if you do these exclusions based on the benchmark you have, here's how much you're going to deviate from the benchmark you want. That's one way. At least for us, like every manager we will select, like how we've spoken about it to clients, we've put ESG and non-ESG managers in searches together, and you compare them on performance, up and down capture, Sharpe ratio, whatever your metric is. And then it's like all things equal. It's like, oh, do we like ESG? So it's like, I think our view has been like, because there is a lot of good empirical evidence contradicting the benefits of ESG from a risk and alpha generation side, we're just like, all right, let's just like look at this as an investment side and then decide from there, if all things are equal, do we care about ESG enough to actually invest in it based on the investment side first?
And you would need a long-term, well, you gotta take oil out, especially.
Only if they want to,
Goes your way or against you.
only if clients want it. Like I said, like some of my clients who have ESG friendly like investment policy statements are not fossil fuel free and they own energy, but they access that ownership of energy through managers who are very forward thinking on proxy voting, who are voting against not all, but most directors for like the big energy companies.
We are very much out of time, so I'm sorry. You've got a question and other folks have questions. I'm sure that folks are happy to stay around for a minute to continue the conversation. One shameless plug, as I said earlier, the Restandi Center and the Stigler Center are doing a series on unpacking ESG with the Financial Times. That series will start, I think, on May 14th. It's a series of virtual talks, and Vern, maybe I can send out a link to all of you for that. I think it'll be a lot of interesting conversations. Professors Bertrand, Lois, and Zagalis will be participating in those. So, Guy, Liz, Ibrahim, thank you so much.
Thank you.